All right, we're going to get started. Hopefully all of you, your audio is working. So welcome. Hello, everybody. For those of you on the West Coast, it's still nice and sunny. Here in New Jersey, it's dark already. It's that time of the year. Welcome to 50 years and 3 bear markets. I am here with my right-hand man, Justin Esposito, a newly minted fellow certified financial planner, CFP, here at Bodnar Financial. So we'll start with a big round of applause for Justin getting his CFP. Couple of housekeeping items here. You've probably noticed already that you are all muted. You were muted when you came in on purpose, because I don't need to hear your dog barking in the background or the Amazon delivery guy ringing your bell 3 times. So you are muted. Also, your video is off. That way I don't have to see like my brother making a face or my grandsons making noise and making funny faces at me, right? So if you keep clicking on the buttons, it's not your imagination that it's not working. It's not working because I have it turned off here at Mission Control. Other housekeeping item is we got a lot of requests wondering if this is going to be recorded, and it is recorded. It's being recorded now. So, and the goal is for it to be posted on the Bodnar Financial YouTube channel. Yes, such a thing exists, believe it or not. There is a Bodnar Financial YouTube channel. In fact, those of you who were on the webinar last year, which was Investments 101, that webinar is up on the YouTube channel. It's actually got a lot of views. So following this meeting, probably tomorrow morning, Justin will send out an email. Thank you for attending, blah, 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 but also with a link to that YouTube channel. This presentation won't be on the YouTube channel that quickly. It usually takes about a week. All right. All right. Housekeeping out of the way. So now we can get started. We are together, all of us, and there's people still coming in. There's probably going to be about 45 to 50 of us by the time, everybody gets online here. So together, we are going to look at some historical data that demonstrates why big bear markets are not to be feared. Even though you look at this big brown bear, I fear him. But when it's a bear market, in fact, we should be celebrating the arrival of the bear, right? Bear markets play a crucial, critical role in long-term investing. And by the end of this presentation, I'm sure you're going to agree with me. In fact, I almost want to use the word guarantee, but I can't, right? Because it's a bad word in my business. But I think you're going to agree with me, and that's no bull. See what I did there, Justin? You get that? Bulls, bears. See you like that? That was good, right? That was good. All right, so let's move on. I want to start with this because it's really the reason we're all here. We're here hosting this seminar to help you manage your emotional state around bear markets. And the reason bear markets are scary is because nobody knows how or when they will end. And I mean nobody. There's people that make guesses. It's kind of like that old saying about the broken clock being right twice a day. And it is. There are certain perma bears out there that they're always saying that the world's coming to an end. And then eventually when we have one of these big sell-offs, they look brilliant, right? But the other, 300 days a year, not so much. So the reason bear markets are scary is nobody knows how long, when they're going to start, when they're going to end. Nobody knows anything about them. And longtime clients have heard me say many times over the years, there are no facts about the future. We don't know what tomorrow will bring, or the day after that, or the day after that. Nobody has the magic crystal ball, but we do have historical trends. And as good old Harry Truman said, the only thing new in the world is the history you don't know. Gotta love Harry Truman. And Harry knew a little bit about forecasters and how they can get it wrong from time to time. One of the classic photos in American history, Dewey defeats Truman. So for you millennials and Gen Xers who are like, who the heck is Harry Truman? Google it. I Googled Dewey defeats Truman and read the story about this night in American history when this man with the glasses from Independence, Missouri, was on the back of the train in Chicago holding up that newspaper. One of the great stories in American history. All right. So the only guide we have to work from is really history, right? And history tells us the following, that the stock market drops 10 to 15% every year on average. So let's read that a second time together. All right, everyone at home now, read along with me. The stock market drops 10 to 15% each year on average. Every year for the rest of your investing life till you die. And in fact, we just went through the classic 10% sell-off in the months of September and October. And as I've heard Justin on the phone say to at least a half a dozen clients, it's so hard to time because right after this 10% sell-off in September and October, we get something like November, where I think the S&P was up like 11% for the month, something crazy, one of the greatest months in stock market history, right? So that's why this is so hard. So history tells us every single year, if you're going to be an equity investor, if you're going to invest, and remember, when we say the stock market here in our office, we really mean the S&P 500, right? The 500 largest companies in America. When the 500 greatest companies in the country drop 10 to 15% every year. The second fact that we know is that the stock market drops 20 to 30% every 5 years. We call these double sell-offs, 10 becomes a 20% sell-off. We call these bear markets. And then finally, the stock market drops 50%, right? That's the big groan, right? 2 to 3 times a century. And here in our office, we call these the grizzly bears, right? This is the grizzly bear sell-off, and that's what we're going to focus on tonight. The next fact is nobody, we or anybody, we don't know the dates the market will drop, and we don't know the dates that it will recover. But what we do know from history is that it always has recovered, and then some. These are all types of market corrections or sell-offs. And I'm here to tell you that they are absolutely, positively, completely normal. There is nothing strange about them, and they shouldn't be a surprise. So I'm going to hand it off to Justin now, and he's going to take a walk down a lane with this beautiful polar bear here.
Well, hello, polar bear, and hello, everybody out there. Glad to be here tonight. So what makes a market correction a bear market? It's a decline in the stock market of at least 20% on a closing basis. And as John just alluded to just a few moments ago, these happen typically every 5 years, so they're a common occurrence. But a bear market is technically a decline in the stock market of at least 20% on a closing basis. Now, a bear market deals with stock market dips. A recession is a different animal and shouldn't be confused with one another. A recession is a serious downturn in economic activity lasting months or even years. And amazingly, there is no fixed official formula for declaring a recession. Although a common rule of thumb is that 2 consecutive quarters of negative gross domestic product, GDP, means we are in one. Sometimes you hear the people on TV arguing whether it's a recession or not a recession, because there is no official formula. But like I said, typically 2 consecutive quarters of negative GDP means we are in a recession. Now, historically, the stock market tends to peak before the start of a recession, and it hits bottom before the recession is over. So in other words, the stock market has usually recovered faster than the economy. So while recessions and bear markets may occur simultaneously, they should not be confused with one another. They are different. So let's put recessions aside for now, and we're here to really talk about bear markets. So if you were born before January 10th, 1973,
Wait a minute, January 10th, 1973. Wasn't everybody born before January 10th, 1973?
well, not everyone in this room, and I'm not sure about everybody out there, but I would say maybe the majority, all right? So,
You mean the adults, all the adults?
yeah, yeah. So, but if you were born before this date, January 10th, 1973, you have lived through 3 episodes in which the US stock market went down by roughly half. Not one, not two, but 3. These declines were driven by very real crises. The news headlines were scary, right? They were not fun times. So those tiny 10 to 15% corrections that we see every year that John mentioned, or even the 30% dips we see every 5 years on average, they're like cute little bear cubs. These 3 right here, we refer to these as the grizzlies.
Right. So the Grizzlies, right? There's 3 of them here, and we're going to go through them one at a time. We have Nixon and Watergate, 73 to 74, down 48%. We have the turn of the century here. This is kind of the tech wreck, down 49%, and then the financial crisis. All right. So what you see on this chart is every bear market. So remember, every year you get the 10% sell-off at some point, intra-year, somewhere from January to December, it's inevitable you get the 10% sell-off. And then every 5 years or so, you get a true bear market where the market goes down 20% or more. This is a list. What you're seeing on this page is a list of every bear market since the end of World War II, right? Highlighted in blue are the grizzly bears, right? So I'm not going to go through every single one, but just to show you how the chart works, right? This was the date of the first market peak post-World War II, May 29th, 1946. The S&P 500 peaked at 19.25. Now, there was no front page article in the North Star Ledger that day, for those of you that remember the North Star Ledger. It's still around, but subscriptions are down, like every newspaper. But there was no headline in the North Star Ledger that said, market peak, get out. No, there was probably in the business section an article that talked about how the party continues in stocks, new record high, and if you don't get in, you're going to miss the party, right? Nobody knew that was the peak. For the next 133 days, this market dropped from 19 to 14. That's a 26% loss over 133 days. And the same thing happened on October 9th, 1946. There was no big headline, buy today, stocks are on sale, this is the bottom, the worst is over. You never see that headline. But that should, if you got in your time machine and went back in time, that is a headline that you wish you had seen. All right. So this is every one. The same thing in 1948. Here's another sell-off in 1957. Here's 1961. Here's a rough one in 66, 240 days. Here's Kent State and America basically on fire with the Vietnam War. That was 543 days. And then we get into Grizz territory, right? And what that first Grizz looked like was this, all right? This grizzly bear lasted 630 days. It was the largest decline in the S&P 500 since the Depression to that date. So it was the largest decline since the Depression. And it was marked by just a crescendo, just a potpourri of crises, right? We had economic crises, financial, political, even geopolitical, right? when you look at what happened in 1973, 1974, the first thing was the first oil embargo. This thing called OPEC came on the scene. Of course it did, because I was getting my driver's license right around this time. And what happened as soon as I got my driver's license? Oil went to the unthinkable price. Gasoline at the pump went to the unthinkable price of $1 per gallon, $1 a gallon. And it sent every teenager in America into a hissy fit. All right. And because of the price of oil, inflation exploded. It caused a recession. Unemployment peaked at 9%. And then the little cherry on top was Richard Nixon and Watergate. I mean, that was economic, financial, political, right? And even geopolitical due to OPEC, right? But that's not the whole story, right? This decline of 48% is only half the story. Because if you finish the story, it looks like this. Here's this drop from 120 to 62. This slight, when you look back in time, it's a slight, it doesn't look like a 50% sell-off. But believe me, if you were there at that time, it felt like a 50% sell-off. All right? But that's what the S&P closed at when we were putting these slides together to get them approved. We used December 1st, the first day of this month. Today, the the S&P 500 closed at 4,719. Right? It's still even higher than this, right? So this is the story that you lived through for those 630 days. But this is the story you lived through if you hung in there for the last 50 years.
So let's go to Grizzly number 2, the dot-com bubble. This was probably the greatest stock market bubble of all time. I mean, after Enron, no one really could believe any accounting numbers. And then to throw, salt to the wound, you had the horrific day of 9/11, right? So if you look here, in March of 2000, the S&P was at 1,527, and it declined to 776 by October 2002, which is a 49% decline. So it was the implosion of the dot-com bubble. The NASDAQ itself was down 80%. We were in a recession. As I said before, Enron and the accounting scandals. And then the cherry on top, the horrific terrors of 9/11. This grizzly lasted 929 days. But once again, that's half the story. If you look at it, December 1st, the first of this month, the S&P closed at 4594. And as of today, it's a little bit higher, like John mentioned. It's up to 4,700. So when you take a step back, it doesn't look as painful, but when you're in it, it certainly is.
Which brings us to the big guy, the biggest grizz of all, right? Right. Here we have Grizzly number 3. And in a very real way, you could say that this 2007 through 2009 grizzly bear was this generation. Those kids born after 1973, right? It's really this generation's 1929 through 1932 experience. This is the Great Depression for this generation of investors. And I know in our office, the cry that went out from phone calls that came into the office was, Bodnar, I listen to your stuff, I read it, but it's different this time, right? Isn't it different? Like, come on, you got to admit it's different this time. But, was it really? Was it really different? I mean, yeah, it was down 57% instead of 49, okay? And, it felt a little different because there was the subprime mortgage catastrophe, the global financial crisis. I mean, a complete iceberg for liquidity. I mean, banks, forget loaning money to me and you. Banks weren't loaning money to other banks. It was a complete lockdown. Everybody took their cash, put it in mason jars, and buried it in the backyard. There was no cash, and nobody would lend anybody any money, right? That's a big thing, right? That's like the Depression. It was the longest, deepest recession since the 30s, and unemployment actually reached 10%. But like I said, is it really that different? No, it's not, right? Because again, there's your dip, and it comes back to today, 4,700. So I think through these slides, what we're trying to establish is that none of these big three bear markets were the end of times. It was not the end of times. And if you weathered the storm, you landed way up here at the peak of the mountaintop.
I like looking down.
You like
That was
looking
my
down.
first year in the business.
Right. So when was the first year in the business?
Financial crisis.
Oh, great timing.
Yeah.
So every single day during those bear markets, investors were inundated with doom and gloom, right? It was everywhere. Doom on their television sets, doom in their newspapers. For the last two grizzes, it was doom on their smartphone, their iPhone or their Android. We didn't have those in 1973, 74, but it was doom, doom, doom. And when the stock market drops, the media is trained to get into immediate Armageddon mode, right? Because they know Armageddon sells, right? In the old days, if it bleeds, it leads. That was the old line, right, about television news. If it bleeds, it leads. We got to get people to watch the show so we need those eyeballs. They need to grab our attention, film at 11. Just because they can grab our eyeballs, right? Today they call it clickbait. It doesn't make them right. Just because they can get our attention with some crazy headline, it doesn't make the story that follows right. And I would argue it actually makes them very dangerous, right? So I love this quote because it predates me in the business. When I came into the business in 1981, Sir John Templeton was already Sir John. For a guy born in Kentucky, he made so much money that he got knighted, right? So Sir John was already famous amongst the investor class for a lot of things, but really for he had Warren Buffett one-liners before Warren was really famous, right? It all started with Sir John Templeton. And this is one of his great quotes. Among the four most dangerous words in investing are, "It's different this time." This is, and of course he would say, no, it's not. It's not different this time. It's the same story over and over and over again.
Yeah. Case in point, the stock market is up a multiple of 50 times, 50x, in the last 55 years. Now, you might ask, what did you have to do to get a 50 multiple? And this is where I wish we had kind of like a drum roll, right? I'm going to build up some anticipation. I'm going to reveal the answer, but I'm just going to give you a second to think about it. What did you have to do to get a 50 multiple? All right. Just sit there. All you had to do was write out the scary headlines, not panic, and not sell during a market decline. But that's not so simple during those times. But that's what you needed to do. Just sit there like this bear.
That bear looks like he does a lot of sitting.
I think he's been sitting for a long time. It's a big bear. So history tells us, that for disciplined long-term investors, the stock market always goes up. It just doesn't go up every day. I think you might have heard John say that a plethora of times over the years. You're going to hear me say it, and you'll hear us continue to say it. And we're also going to say the advances are permanent and the declines are temporary. Declines only turn into losses when you panic and you sell. Now you might be wondering, how was this possible? Why did stock prices rise over time despite all these crises that were very real and scary? It's simple, because stock prices are determined by one thing: company earnings. Although human emotion may drive stock prices in the short term on a daily or weekly basis, the long-term value of companies is determined by their earnings, nothing else. So for all the data nerds like myself who likes proof and numbers, this is what that principle breaks down to. Even the shares of America's finest companies have experienced frequent declines in price. And as you can see, despite the setbacks driven by all those current events that took place between 1972 and 2022, leading U.S. companies have continued to grow their earnings and dividends strongly over time. You can see that the S&P 500 index on December 31st, 1972 is at 118. The end of last year, 3,840, a multiple of 32 times. And guess what? Magically, earnings went from $6.17 to $219, a multiple of 35. Can you see how correlated that is? Stock market prices are driven by company earnings. And why have earnings risen so much? Well, one, it helps that U.S. population rose by 50%, so that was certainly helpful. But the big things were productivity and innovation. Americans increased their productivity almost 2.5 times in real inflation adjusted terms. Things like computers and things that helped us be more productive came out. But the largest factor by far was innovation. Now I'm going to read this twice because it's even hard for me to believe at times, but this is true. So 9 of the 10 most valuable companies in the S&P 500, they did not exist in 1972. All right, so 9 of the 10 did not exist in 1972. You might be thinking, hey, what's the number one company valued today that didn't exist in 1972? And if you're thinking, and the word Apple comes to your mind, ding, 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 Apple did not exist in 1972. And 8 other companies just like Apple did not exist in 1972. You also might be thinking, hey, what's the one company that does exist today?
No, we're not going to tell you. We're not going to tell you. Send us an email. Respond to Justin's email that he's going to send you for thanking you to be on this, and give us your guess. And no cheating. Don't Google it. Give us your guess of what the one company out of those 10 did exist in 1972. And I'll send you a present. I'll send you a present.
Perfect.
All right, since I stepped all over you there.
No, I like it.
So now we'll talk about dividends. So earnings and dividends. Remember, our minimum goal as investors is to earn a return that offsets the effect of inflation, right? If there was some magic product out there that we as financial consumers could put all our money into that guaranteed us that we would earn interest at a steady rate that outpaced inflation, right, year over year over year, then we would buy it. But that doesn't exist, right? So as concerned as everyone always is about stock prices, in retirement, we really strive to live on our dividends when you think about it. We don't take our LPL account statements to the store to buy groceries. We bring cash, and those cash, that cash comes from the dividends off of our equities or the interest off of our bonds or our CDs. Cash is what we bring to the grocery store, and that's what dividends are all about, right? So the takeaway on this slide is this green column, right? Look at the rate at which dividend growth has outstripped inflation, right? There's no other thing to say other than simply fantastic. It's right. Here is the cost of living. This is consumer price index over here, right? This is food in the grocery store and gasoline at the pump and heat in your house, right? This is inflation, the consumer price index, CPI. And on December 31st of 1972, the CPI index stood at 43. 50 years later, that index had grown, right? We all know that all of bills, the cost of living definitely went up. This is not a surprise over the last 50 years. And it went up 7 times. It went from 43 to almost 300. You say, yeah, inflation is a curse in your retirement. It's a cancer. But look what the dividend on the S&P 500 did over those same 50 years. It was $3 at the end of 72, and it's almost 67 bucks. Well, it is over 67 bucks today. It's almost closer to 70 bucks because this was the end of December 2022, right? So simply fantastic slide and a very cute little cub there, too. But to be fair, since we are here discussing very large stock price declines, right? The grizzly bears. So I think it's fair to talk about recovery, right? Markets sell off. So what's the time to recovery is a very, very legitimate concern. And so you might ask, since the end of World War II, because that's what I've been using, right? Since the end of World War II, with dividends reinvested, what has been the longest recovery time to break even? What has been the longest recovery time to break even? I'm actually going to give you the answer. I'm not going to make you email it in on this one, right? Since the end of World War II, it's been 5 years and 8 months, right? With dividends reinvested. That is the longest recovery time. The longest, all right? And it was at the turn of the century, right? 5 years and 8 months after that incredible sell-off there, the tech wreck, right? So that's the longest, all right? And that's according to one of the foremost scholars of capital markets we have. That's right out of my Stocks for the Long Run, second edition by Dr. Jeremy Siegel of the Wharton School. That's where I got that data from, right? So that's 5 years and 8 months of waiting it out. All right.
Looks like he is.
Yeah, this is my guy back here. 5 years and 8 months of putting your faith in historical trends, not the pundits of pessimism on the television and your newspapers and on your iPhones. So I guess we can say the big boy here, he's not lazy. Let's just call him disciplined. Right? He's disciplined. He sits there and he's disciplined. He is a handsome guy. Look at him. All right. So waking up every day, choosing not to panic and sell out, choosing to actually take no action, choosing inaction is not as easy as you think. Again, due to just the pounding we take from the media. And because of that, over time, you start to lose sight of the big picture. All right. And as Winnie the Pooh said, people say nothing is impossible, but I do nothing every day. And that's pretty good advice if you consider that slide and this guy, right? Do nothing, right? So let's revisit the big picture right now and refresh our memory. And we're going to let Justin run through one of the classic charts of all time.
Yes, the Ibbotson chart, of course, when you're looking at the big picture. So what this chart does is it shows you all the peaks and valleys of different asset classes year over year. Small and large cap stocks are the two blue lines up top. Bonds, T-bills, and inflation in the gray area are below it. When you're looking at the big picture, all those dips and drops, they look kind of small. But while they're happening, it feels like the end of the world. So you have the Great Depression. You have Pearl Harbor, JFK assassinated, the oil embargo, 9/11, and then the pandemic, right? Those are very big declines, but taking a step back, they don't look so bad, right? So if you focus on the days and lose faith in the trend line over decades, things can start to feel pretty intense, and they feel intense pretty quick. But when you zoom out, you realize these dips are completely normal. And you'll notice that the stock market tends to roar back as sharply as they drop. John just gave you earlier an example of Q3 this year. After getting a couple of months of shitty statements with account values declining, you get the surprise in November, which is one of the greatest Novembers in stock market history. You don't get windows of time to leisurely return to the market. That's why it's so important to buy and hold. John keeps this doodle hanging up in the office, so you might have seen it. It's simple, but it tells the story. Days versus decades. Successful investors tune out the days and they focus on the decades.
And that's a real doodle. That is a picture of my corkboard in my office. If you've ever seen me open the doors to the whiteboard, there's cork on one side, and you can see it's just I printed it and I tore it out, and I look at it every day, right?
Yeah.
You know, we really do have, you have a choice. You can focus on this, or you can focus on this, right? Decide which one you want to focus on. All right. So if you screenshot, if you take that smartphone out of your pocket or off the kitchen table or wherever you're watching this, if you screenshot one slide from this webinar today, make it this one, right? This is our creed. This is the creed, right? This is the creed of the successful long-term investor, right? Number one, we know bear markets are coming. And if you didn't know, you know now. We just went through a couple slides, and I just went through history from the end of World War II. It's not an if, it's a when. So number one, successful long-term investors know bear markets are coming. They're always coming for you, right? Number two, we don't know when they will arrive or when they will end, but we know they will arrive and we know they will end. Number three, you're going to see a 30% decline every 5 years. It might be 4 years, might be 6 years, might be 7 years, but there's going to be a big 20 to 30% decline about every 5 years in your investment life. And finally, you're going to see a 50% grizz 2 or 3 times in your lifetime, at least in your investor lifetime, right? And when these things happen, you're going to be like this guy, wrong guy. You're going to be like this guy, and you're going to be disciplined and do nothing, right? That's the creed, right? Stock owners keep the faith in the trend line. They sit through the dips. They focus on decades, right? They focus on decades rather than days. And we as investors ultimately have our individual right to decide what perspective we want to take, right? We can link our emotions to this, or we can link our emotions to this. You get to choose. I know which one I choose, right?
So the moral of this story is best summed up by Warren Buffett's partner, no one other than Charlie Munger, God rest his soul, right? And I think he knew a little bit about investing in the long term. And what he said is if you're going to be in this game for the long pull, which is the way to do it, you better be able to handle a 50% decline without fussing too much about it. So you get to decide which attitude is going to be your emotional state. Even in the most upsetting times, we have a choice. You can say it's different this time, or you can say this too shall pass. You might recall John's latest white paper. We choose this too shall pass, and we're going to stick by that. And it's supported from history that this too shall pass, but you get a choice.
All right. Now, it's normal to feel that fear, right? I mean, you wouldn't be human. It's normal to feel fear when you watch an average of a third of your invested capital melt away in a bear market, right? And no one can tell you, no one anywhere can tell you, even if you call our office, we don't have that magic, ball. No one can tell you where or even how it will end, or watching half of your money melt away. As humans, we are wired to react to our fear in order to survive. You know, I did a paper years ago called Wall Street Needs More Anthropologists, right? Because they were focusing on money, you know, dollars and cents and data all the time and forgetting that there's actual human beings who are investing their money. As humans, we realize each bear market feels uniquely different as we live through them. The current events happening around those bear markets that we just went through are genuine disasters. That's not data we just made up. Who lived through the pandemic without feeling like the world was ending at least one time, right? We all felt that way. The individual circumstances in each case are just different enough to frighten the bejesus out of us and to frighten us into thinking that it's different this time. It's different this time. And that there's no way the long-term economic progress and the growth of earnings and dividends can continue. I don't care what John Bodnar says, right? That's how scary it gets sometimes. But each of those big grizzes had one important thing in common. When we were living through them, all of us, it was impossible to say how they'd get solved. But you know what? They did get solved. They got solved, every one of them. You didn't have to know how they'd get solved. You just had to maintain your faith in the historical record and don't liquidate your long-term portfolio in a panic. And as your financial advisors, we are here to help you deal with those feelings because we're feeling them too. Don't think we're not feeling them. We're here to empathize with you as you feel the fear and to help you decide not to act on that fear. That is why we are here. That's why I've been placed on this planet. All right. This is my job to work together with you to help you overcome those fears. So we're coming up on 1 hour. We're just kind of nailing it's 59 minutes. So thanks for being here tonight. We hope you found this helpful and interesting. And if we haven't met in a while, please call the office. We're probably due for an annual review. And so happy Hanukkah, happy Merry Christmas. Have a great new year. And we will see you in the new year. Oh, wait a minute. There's one more slide. Sorry. Yeah, my lawyer wants to say Merry Christmas too here. So have a great new year and Merry Christmas to all everybody. There you go. Especially you, Jeannie Bass, if you're on the call.
Christmas.
If you figured
Happy
it out.
holidays.
Have a great year. Bye, folks.